Good afternoon, everybody. My name is Jeffrey Halley. I'm a Senior Market Analyst here at Oanda Asia Pacific here in sunny Singapore, and welcome to the weekly Precious Metals and Commodities commentary. In this presentation, I will cover the four precious metals. We'll take a quick look at copper, then we'll move to the energy complex, and finally we'll take a look at some of the soft commodities that you can trade on the Oanda platform. We'll take a look at some of the charts, and I'll give you some of my thoughts and opinions on what I'm seeing at the moment with regards to those, and perhaps a few random thoughts about the world in general and the markets and what is actually impacting the markets at the moment. And I guess as we run into the non-farm payrolls tomorrow evening in New York, which will be the highlight of the week now, the main theme seems to be still dollar weakness. This has been driven by a couple of factors. Namely the chaos on Capitol Hill, not just from the presidential side of it, but also the inability of both houses of Congress to actually, get anything done. This has slowly but surely undermined faith in the US dollar and the Trumpflation story. And what we've seen of recent times is more and more traders leaving via the exit door from long dollar positioning. What we're also seeing is perhaps the Fed starting to blink on its inflationary outlook. They have been saying that the low inflation numbers were transitory and that things would pick up, but perhaps this isn't quite correct. Maybe now they are starting to think that this undershoot in the data is more structural rather than transitory. So we have a Fed meeting coming up in September that will be live, and that would most certainly impact on markets. Running into August, though, we will be running into the summer doldrums where most politicians seem to go on holiday, and usually a lot of the market participants are away sunning themselves on the beach somewhere as well. Nevertheless, there is a lot going on in the world, and we have seen some very interesting price action over the last week. As you can see in front of us now, we have a very multicolored gold chart. Don't be frightened by that. What I've done is drawn some Fibonacci retracements on it. Let's have a look at gold itself. It's been on a fantastic run higher over the course of July, as I said, as the Fed has mollified its inflationary tone, and also with the turmoil over in Washington DC, but also geopolitical turmoil around the world as well. And all these things always combine to see gold with a more positive note. Certainly, I think the weaker dollar story is the main thing that has been driving it. We have actually moved up through the 100 and the 200-day moving averages. That's the red line and the blue line, and we are solidly still above it. Although in the last day or so, as the dollar has actually made a little bit of a comeback, we have seen some short-term positioning, long positioning exiting the market, and we saw gold here dropping it looks like about $10 overnight. Nevertheless, it still seems to be in a bit of an uptrend. We do have, if I just blow this chart up a little bit higher, move this chart up a little bit higher, and we can see here we've dropped about, that does actually look about $11, not $10 overnight. But we are still holding above this red line, the 100-day moving average, and that's today at 1252.15. And I think as long as this moving average holds, it is actually just a little difficult from a technical point of view to see gold as perhaps having a major technical turn. Below that level, we do have the Fibonacci retracement line, although it hasn't really played much of a part in the move up, and that is the 50% retracement, which is at 1249. So we do have a small zone of support here. Up above, we have resistance from Monday's high at around 1274.20, and then a key level here will be 1282, this previous high in early June before the massive sell-off. Before we can even start talking about attacking this major double top here above at 1296 and the 1300 level. What will drive this? I think we really will have to see a more selling in the US dollar space in order to perhaps give gold another kick to the top side. Certainly the RSI is not suggesting we're overbought, so there's no worries from that side of things. Let's move over to silver. Silver itself actually hasn't really moved with the same venom and power as gold higher over the month. Although, as we can see, it is still has been solidly in an uptrend for most of July. I think there's a couple of reasons for this. The main reason I feel is lack of liquidity. As you can see from some of these whipsaw price actions here, long run up, gives back 50% of it in a couple of days. Long run up and then gives back all of that move in the space of about a week. And I think these whipsaw actions have taken a lot of liquidity out of the market with traders. And I think what we're seeing is traders preferring to reflect their precious metals positionings in the most liquid commodity, and in this case the biggest market and the most liquid one is gold. And I think this is something we were seeing in both silver and to a certain extent platinum as well, and this is why perhaps there hasn't been the same level of interest in silver this month as there has been in gold. Also, the price action itself is not exactly filling me with joy. This uptrend that we've enjoyed over the space of July comes in at around 1675. The support line has been well and truly broken. In fact, we could almost say this is an outside reversal day yesterday, where we made a new high but then closed below the low of the previous day. So that in itself would be a bearish technical signal. Breaking through this trend line support is also perhaps a bearish technical signal, and perhaps silver is leading gold in the price action at the moment, as it sometimes does, and perhaps it's signaling that we could see a deeper correction in precious metals, especially if we get a good figure out of the non-farm payrolls tomorrow night. Support will initially be around the lows of the day, which is around 1643.50. On the top side, we can see a resistance line up here at 16.91. We did have a little peek through it yesterday, but it closed a long way below it, so I still feel this is valid. But the key resistance level for silver bulls will be this 100 and 200 day moving average, this red and blue line here. And these today are sitting at around 17.05 and 17.12. So we really need to see silver closing above these two lines and before we can really start getting excited again, I think, about further top side. Of course, the next point above that sticks out like a sore thumb, and that's the 1776 level. Popping over to platinum. Now platinum, if we just squish this chart up so we can see a bigger picture of it, it's been in a perhaps a wedge-shaped formation for most of the year, and actually the price action in platinum is still looking a bit more constructive than silver. We've most certainly broken out of this long-term wedge pattern to the top side. And we've also broken out of the 100-day moving average, which is sitting around sort of 939.40. This wedge line here, the ascending trend line, now becomes support, and that sits around 925.45 today. What we do seem to be seeing at the moment, though, is some consolidation from platinum between its 200-day moving average, the blue line above here, and the 100-day moving average, the red line here. So the red line is at 939.40, sorry, 951.57.6 is the 200-day moving average, and those are your two immediate support and resistances. Clearly down here for those longer term followers of platinum, this level is key, this 889.425, which is the long term support line. We move over to palladium. Now palladium is a bit more confusing in the precious metal setup than gold and silver, particularly because palladium actually has huge industrial applications, a bit like platinum actually, but probably more so. Most usually within the catalytic converters of most of the cars that you and I may drive each day. And this means that the price action in palladium tends to be formed by both the precious metals outlook and also the industrial demand for palladium. And we can clearly see this has been on the almost mother of all bull runs this year, having basically doubled in price. And the price action itself still remains quite constructive, having moved higher with the other precious metals over the course of the last couple of weeks. We do seem to be in a consolidation pattern here at the moment. The resistance is around 918.00, and longer term support is around this 828.40. And what's really important about this level is that the 100-day moving average, this red line, is within spitting distance of that support line. So it comes in at 827.05. So to me, a combination of two factors coming together at the same level means that this is a very important level indeed. And it's a little hard to see Palladium forming a bearish outlook unless we saw a close through there. Having said that, if we were to close through there, we still do run smack back into this ascending trend line support, which today is sitting at around the 803.9 level, call it 804. So actually on the downside, Palladium still does actually have quite a lot of wood to chop, even with the 200-day moving average, this rather shortened blue line behind it, which is sitting around 778.25. So that's the precious metals taken care of. Let's pop over to something more industrial. Let's have a look at copper. And copper has most certainly, if I just squeeze this chart up, awoken, shall we say, from its long slumber. We can see copper here has been consolidating or resting, if you like, in this range at around 245 up to sort of this 273, 274 range, call it. 275, I'm sorry. So sort of 245, 275. Copper has been ranging there since last year after its last run up post Mr. Trump's election and the Trump reflation play. We can see here it has actually finally popped out of the top of this range and made some sterling progress up to the 285. Around the 285.70 area. This ascending trend line is offering support, and today this is sitting around 278.15, and I think as long as the this support line holds, then the outlook for copper, just from a technical basis, does continue to look constructive. So what has driven or awoken copper from its slumber? Well, there's a couple of things going on here. One, of course, is the weaker dollar story, which will increase the price of copper because you need to pay more dollars to buy the same amount of copper that you did, for instance, last month. But the other one is actually good data out of China, and China being the largest user of copper, where China goes, copper will also go, so to speak. So China's data has been slightly to the upside of recent times, and that's increased the price of copper as people anticipate higher demand in that space. And we can even see that in the daily and futures over in China with the iron ore prices. Longer term support, as I've mentioned earlier, is going to be now around 277 and 296.50. This figure way up here is going to be the longer term resistance. If we pop over to natural gas now, popping into the energy sector, looking at the price action here, you could be a little confused because frankly oil has been on a massive bullish run to the top side of recent times, particularly WTI. Yet we look at gas and all we see is some sideways to perhaps negative range trading. So why is natural gas not rallying with the same verve and power as West Texas Intermediate, for instance? Well, the actual answer to this one, I believe, lies in the shale producers themselves. Most people talk about shale oil, but in fact, shale gas producers are also a major part of that setup. The problem in the United States is that these shale gas producers are actually producing a lot of gas, but the United States doesn't have the pipeline infrastructure to move that gas around from the shale oil fields, wherever they may be in the Permian Basin, to where their clients really need them, say in sort of Seattle or New York in the middle of winter for heating and such like. So more gas gets put into storage, more gas in storage equals lower prices, and I think this is why we're having this counterintuitive price action. Unfortunately though, for gas, it has been in a wedge shape. We can see, although I've extended these lines, this wedge shape here, we can see over the course of June and July, and it's actually broken to the downside now of this long-term support line forming the bottom part of the wedge. That today lies, or that actually was around the 286 area, This now becomes resistance. So the first resistance in natural gas is where this line comes in now, which today is at 287.60. Technically, the price target on this wedge shape should be something roughly about the size of the wedge. Actually, we'll take this piece here, okay, and that gives us an indicative price target of around 253, which is coincidentally where the next long-term support is on natural gas, this line here at 253.20. So again, spitting distance from each other. This also tells me that this line is actually very, very important from a longer term basis for the outlook for natural gas. I also will draw your attention to a possible head and shoulders here, and this again is a negative pattern for natural gas. There's a shoulder here, head here, and then another shoulder here. Now I do need to do some more work on this, and I need to see how the price action develops, but I will keep you viewers informed as to my thoughts on this going forward. But nevertheless, if it is indeed a head and shoulders pattern, that would be a very negative outlook for natural gas. But I think it's just a little too soon to say whether this is actually the case or not. Up above, natural gas has resistance here at 309.60, this red line, and also the combined 100 and 200 day moving averages, which today are sitting at around 305.5. So these two, there is definitely some wood to chop on the top side here for natural gas. Let's move over to Brent crude. And if you're looking for some volatility in your trading portfolios, certainly you couldn't go wrong by trading oil, it seems, these days. Again, another multicolored chart. Let me see to move this down a bit so we can make it a bit clearer. Righty ho. Hang on, let's just fatten this thing up as well. As I've said, certainly if you're looking for volatility, you'll find it in the oil markets. Since the lows here at 44.25 over the course of the last 6 weeks, we've raced higher all the way back up to around the 52 mark today. There's some interesting formations here actually. Most importantly, I want to draw your attention to the triple top that's formed here at around 52.70. Okay, and this has particularly been formed over the course of the week, this early part of the week's price action and from last Friday. We can see one point here, we can see an almost touching point here, so close that I'm going to call it, and of course the second point here. Triple top, major resistance. From a technical point of view, I think if you want to be bullish structurally on oil and expect to see it moving to the top side around 57, we really do need to see a couple of daily closes above this resistance line. Down below, we seem to be pivoting around the 200-day moving average at the moment. It doesn't seem to be playing a large part technically. What is, though, is the 100-day moving average and this 50% Fibonacci retracement, which is at 50.65. The 100-day moving average is at 50.48, so what are we calling that? 18 cents away from the 50% retracement. And this zone here, if you notice, held the retracement from Monday perfectly. We can see it's traded right down to that level, actually Tuesday, sorry, and that was post the API inventory figures. And it's held it perfectly, and then we've bounced 2% overnight as the US crude inventory figures showed a smaller than expected drawdown, but a drawdown nevertheless, along with some huge drawdowns in gasoline, which has sort of given us this positive price action. So we do seem to be stuck in a bit of a consolidation range at the moment between this 50.5 level and this 52.5 level, and a break of either of these will most likely signal the next sort of weekly to 2 weekly direction of Brent crude. Let's have a look at West Texas Intermediate, WTI. Again, I want to draw your attention firstly to this retracement at 50%, the 50% Fibo at 48 sort of 0.20. Again, from Tuesday's sell-off, it has held this level perfectly before bouncing higher again. In this case, the 100-day moving average is a little further away, around 47.77. Nevertheless, I think this is a key level, this 48.20 area, 47.75, let's call it. This zone here, again, will set the tone for oil should it break on the downside. Behind that, we actually do have another level around 47.20, but this is really the important area right here. Actually, let's just clean this chart up, shall we? Okay. On top, we have a well-formed double top. And this is also of particular note to traders. This is from Friday and Monday as well, and it's around the 50.30 level. So again, a bit like Brent, we need to see a close above this level or below this level in order to really get an insight into where WTI is heading next. And in the meantime, we can expect some choppy range trading between these two levels. Let's pop now over to some of the soft commodities, shall we, and have a look and see what's been going on in the agricultural world. Viewers will know that I've been calling this head and shoulders formation for a while, and we actually achieved the target of it, the shoulder, head, shoulder. We've done that now. That's in the past. A big part of trading is moving on from one battle to the next. So it's actually been a textbook head and shoulders, but that's in the past. So now we need to take a look and see what the price actions are telling us on the charts of recent times. And we have actually seen a fairly good rally off this very long-term support level here, which is at 0.1250. Okay, so this level traces out an awfully long way, all the way back to September last year. And what is actually interesting is it does appear to be a bit of a pivot level. So when it actually breaks, it goes down quite a lot. When it breaks to the downside, it actually extends. And when it breaks to the top side, it extends. And we can see that it's tested on a retracement a few times here in early 2016 and then pushed higher again. And this tells me, after we saw the test here in early or late June, that this is a very, very key and pivotal technical support area that traders should be keeping an eye on. If we have a look on the top side, shall we say, sorry, I was getting my words all tied up a bit there. We can see that the 0.150 area, we topped out there earlier in the week. And this is followed just by the 100-day moving average above at 0.1522. So this region here, 0.1500, 0.1522 is a key resistance area. And if we're thinking about oil and how it's ranging between supports and resistances, we could probably say the same thing to a certain extent about sugar. And in fact, if we draw the line here right where the 100-day is, we can go over to the left and we can see that it bottomed here a few times on the way down. So I think this is definitely a technical pivot point. So we really do need to see either a break below or a break above there to perhaps gain an insight into the next direction for sugar. I do actually want to talk about commodities in general right now, and what I want to say to you is one word, and that is drought. We are having droughts all over the world, or suboptimal growing conditions in a lot of the major agricultural commodity producing areas of the world. Australia, Spain, parts of southern Italy, and absolutely we're having less than optimal growing conditions in the mid and the north of the United States, and also to a certain extent in the across the border in the prairies of Canada as well. This has seen the World Grain Council downgrading production over 2018. This really hasn't been reflected in prices as such. If we have a look at corn, for instance, we can see some very choppy price action here, but I'm not really seeing price action that's showing that the market thinks that this reduced production over the next year is coming into the near-term price action. So I'm asking myself again, why are we not seeing commodities racing to the top side? And I think to a certain extent, it's this whipsaw action that we've seen in earlier trading. And in fact, in the case of corn, for instance, it's not just a whipsaw, I'd call it a chainsaw. We can see announcements coming out, probably weather related here, and it's raced massively higher in the space of a few days, only to lose all of that gain in the space of a few days. Again, we've made our way to the top side, but look how quickly we gave up all those gains in probably the space of a week. And I think actually here it's just a bit of trader fatigue. Traders have been whipsawed, chainsawed, however you want to look at it. And so the participation rate is just not that high in the commodity space at the moment. If we do look at corn though, the key level here appears to be this 349.20 level, longer term support going back to the start of 2017. We'll just blow this chart up a little bit more and zoom into the most recent side of it. And we can see here now that corn is actually also flirting with its 200-day moving average, which is at 359.25, having broken through and closed underneath its 100-day moving average earlier in the week at 365.50. So these two lines now, particularly the 100-day, will be resistance, and we can see a series of lower highs here, which maybe implies that there could be more downside towards corn for now. If we pop over to wheat, lucky last. When I was talking about chainsaws and whipsaws, here's a fantastic example of this. This was actually, this run-up was actually on weather-related announcements and anticipation of poor harvests, particularly in the northwest and the American main wheat-producing areas. Having said that, everybody's clearly piled into this and then slowly being crushed out of the positions. And I think again, traders are sort of like once bitten, twice shy. And in this particular case, we're still seeing that structural readjustment from those optimistic price movements in early July. If we look at the charts though, we have the 100-day moving average down here at 438.77, and this will be the first area of support after this low here, which is around 443.50. And then we have the 200-day moving average, of course, way back here around the 422.60 area. I will note here on the RSI though that wheat is starting to move towards an oversold condition, and we have dropped an awfully long way. So maybe if you are short, you'd want to be just a little careful at this stage, because that RSI could be signaling that we are entering an oversold condition, and the potential for a squeeze back the other way could actually occur. Resistance in the meantime in the short term will be where these previous lows were, and there's 3 of those there, and that is around the 4.5970 mark. As we can see though, we are seeing a series of lower high, lower high, lower high, lower highs here on wheat, and it's just a little a bit hard to get very bullish on this chart. Just looking at how the shape of that downtrend is moving along. But as I said, we do have the RSI moving towards an oversold condition, and we do have droughts around the world and suboptimal growing conditions in a lot of major producing areas. So maybe some caution on shorts might be warranted, as there is the possibility that we could see a squeeze higher. And with that, I'll wind up this weekly roundup of precious metals and commodities, hard and soft. I wish you all a fantastic rest of the week and early next week, and good luck and good trading to you all. Thank you very much.